Hello, my name is Wilkinson from Future Gen Solutions. I thought I'd talk to you today about the recent events that have led to increased market volatility. I think it's very apt that we speak about this, given recently we've seen the Nasdaq go back some 30%, we've seen US markets go back some 18%, and we've seen our market here at home go back by 8%. So I think it's time to actually talk about what's causing it and, more importantly, where it's going. In 2020, we witnessed the fastest recession in terms of correction in terms of markets that we've seen ever historically. Markets fell some 37%, and surprisingly and amazingly, within 1 month, we'd had the fastest readjustment and response from that correction, where markets climbed some 50%. So we are witnessing, obviously, uncertain, uncharted territory. But what we've seen recently in the last few months is the growth of inflation, the continued supply line crisis. We've seen markets start to wobble and correct. This is a test, and it poses a test for investors who, over the last 5 years in particular, have had a reasonably good run in growth assets. And this is the time when the conviction of investors is often tested. What we've found, and this goes back to investor behaviour, is that people can be, unfortunately, what we term predictably irrational. And that means that essentially when markets start to correct, and we saw this during the correction in 2020, rather than basically buying when people are selling, we often see people selling low, and when markets rally, buying high. And that's something that we try to avoid. The philosophy behind this is that essentially the herd sends us a strong signal of what not to do, and that's important. And at this juncture, I'd like to go through to some quotes from some of the great investors. Warren Buffett, who's obviously still running a company today, he made that famous statement, "Be fearful when people are greedy, and greedy when people are fearful." And of course, John Templeton, who spoke about that bull markets are born in pessimism, grow in skepticism, mature in optimism, and die in euphoria. So the time of maximum pessimism is the best time to buy, and of course the time of maximum optimism is the best time to sell. So where are we now? The issues associated with markets are that markets with inflation are due to sometimes recess and decline. That's the nature of all assets. Every asset class doesn't just grow to the sky. Trees don't grow to the sky. For that reason, you've got to take some of the good with the bad, okay? And volatility is essentially the price you pay to be an investor. An investor is someone who's seeking to get returns above and beyond inflation. This diagram I've turned to just illustrates the difference of those who hold the line versus those who basically deflect and run. The green line indicates those people who pulled out of the market back in this example, 2009. Effectively, they removed their money, the green line, and we saw that their losses were consolidated. We saw those who essentially left the market but returned a year later, and while they made the returns, they didn't make the returns that those who stayed the journey made. The people who stayed the journey, their original investment of 100,000 actually tripled it to 300,000, and that was through, as we've seen, one of the worst recessions back in 2010, followed by the recent correction. The point I'm making is that after every volatility is actually opportunity. You've got to see volatility as being an opportunity to obviously buy quality assets, and essentially through the investment managers that we use, that's what they actually do. At the same time, there's other concerns. Yes, we have inflation, we have rising interest rates, but that will determine from the investment managers we use the assets that they select to mitigate that risk and protect your capital. So when we talk to investors, we often say to them, The key thing is you've got to change your emotion. Just because investments fall doesn't mean that's a bad thing, and more importantly, it requires you going back to the fundamentals of why you're investing in the first place. And why we invest in the first place is we're willing to basically exchange cash for capital on the premise that the growth in the capital will be far in excess of inflation. And that's how we maintain our lifestyle, and that's how we maintain our lifestyle now, and more importantly, into the future. I hope today we've actually given you insight into how to avoid the pitfalls of investor behaviour. Certainly you might have questions, and we would welcome those questions, but I've enjoyed actually providing this presentation to you today. And if you have got questions, please contact us directly. Thank you.